Every major financial collapse recorded in history was later called a surprise. It was described by everyone as something unexpected. Right after these collapses, economists said they could not predict them. Central banks said the situation was under control. And the most ironic part was this: politicians were talking about stability only days before the collapse. These people were either lying or refusing to see the truth. Because when you truly study 800 years of financial history, when you make a forensic analysis of collapses, bankruptcies, the death of currencies, and systemic destruction, you always find the same 3 warning signs. And these are not just similar signs. They are exactly the same signs. Identical fingerprints left across different centuries, different continents, and completely different monetary systems. And this is the point where we should stop and think. All 3 of these signs are visible right now. This is not a prophecy. These are documented structural warnings that the world's most trusted financial institutions have quietly pointed out for years, and that already exist in academic literature. Now let's examine them one by one. First sign, the illusion of "this time is different." The most dangerous sentence in financial history is made of 5 words. This time is different. Harvard economists Carmen Reinhart and Kenneth Rogoff spent more than 10 years comparing 800 years of financial crisis data across 66 countries. The name of their study came directly from this illusion. This time is different. The findings of the study were clear. Every systemic collapse in the dataset came after a period when investors, governments, and institutions collectively believed that historical patterns no longer applied. But this belief did not come from optimism. It was a syndrome. Think about Amsterdam in 1637. At the peak of Tulip Mania, a rare Semper Augustus bulb was sold for the price of a luxury house. Of course, when you hear that a flower bulb was sold for the price of a house, you may call the people of that time foolish. But when we look back today, the universal reaction is disbelief. How could some of the smartest people of that period believe that a flower bulb was worth as much as a house? The answer is exactly what Reinhardt and Rogoff documented 300 years later. The Dutch convinced themselves that the traditional rules of value no longer mattered. New wealth from global trade was creating new buyers. The market was now different. Let's look at another similar example. Vienna in 1873. Austria-Hungary was experiencing extraordinary economic expansion through railroads and urban construction. When a journalist asked a leading Viennese banker about concerns over excessive valuations earlier that year, the banker replied, "The industrial age has permanently changed the mathematics of growth. The old patterns no longer apply." The Vienna Stock Exchange collapsed on May 9, 1873. Panic spread to Germany, and then to the United States. A global contraction that lasted nearly 20 years began. The same sentence, 2 different centuries. The same collapse. Now let's look at what the International Monetary Fund said about Iceland in 2007. 12 months before Iceland experienced one of the largest banking collapses in history, the IMF's official assessment stated that Icelandic banks were well capitalized and that the country's strong economic fundamentals would continue supporting growth. Iceland's population was only 300,000. Its 3 major banks had accumulated foreign liabilities worth more than 6 times the country's total GDP. When analysts pointed out this contradiction, the response from the government and banking circles was the same elegant chorus. Iceland was different. It was a modern, advanced Northern European economy. The old rules did not apply. Within 18 months, the Icelandic krona lost 50% of its value. 3 banks were nationalized by the government. The country became dependent on an emergency rescue package from the same IMF that had declared it healthy shortly before. The reason this illusion remains so powerful is not stupidity as you might think. It is incentives. Inside a bubble, the people who say, "This time is different," become rich, while the people who say, "This looks like 1873," appear unable to understand the new paradigm. Unfortunately, careers are built on optimism. Pessimists do not get promoted. Since being right often means losing money, Most people prefer to be wrong together. And this is exactly what makes it so difficult to recognize a warning sign that is clearly visible and act on it. Second sign, the Minsky threshold. Hyman Minsky was an American economist who spent most of his career being ignored. At Washington University in St. Louis and the Levy Economics Institute, he developed what he called the financial instability hypothesis. But this hypothesis was seen as too pessimistic, too unusual, and too uncomfortable. As a result, the academic mainstream largely excluded him. Then 2008 arrived, and economists who had never heard his name started using the phrase Minsky moment during congressional hearings. Minsky's core idea was counterintuitive, but extremely obvious in hindsight. Stability creates instability. When economies are calm and credit flows steadily, rational actors gradually take on more risk. For example, if you have made 5 successful leveraged investments in a row, taking on more leverage starts to look reasonable. If defaults have remained minimal for a decade, the strict lending standards from 10 years earlier begin to seem overly cautious. Minsky mapped the debt accumulation process into 3 stages. The first stage, hedge financing. Borrowers can cover both principal and interest payments from their current income. The loan finances itself. A factory owner borrows money for equipment. The equipment produces income, and the income pays back the debt. The second stage, speculative financing. The borrower can cover the interest but not the principal. The loan no longer pays for itself. It depends on credit markets staying open. A real estate developer makes monthly interest payments but can only repay the principal by selling the property at a higher price. The third stage, Ponzi financing. The borrower cannot even cover the interest from current income. They borrow more money to pay existing debt. The entire structure depends on 2 things happening at the same time. Asset prices must keep rising, and credit must remain accessible. Once one of these conditions disappears, the whole system collapses. Think about the French financial crisis of 1720. John Law, a Scottish financier, established France's first central bank, issued paper money based on shares of the Mississippi Company, and watched stock prices rise by 2,000% in 2 years. Paper money was printed to buy shares. Shares were used as collateral for more paper money. The cycle was elegant and completely deadly. When prices started falling in early 1720, there was no floor. Law fled the country. The financial trauma that followed caused such a huge loss of wealth that the French public distrusted banking and paper money for generations. Remember this: a single financial disaster can shape a society's economic behavior for generations. Trauma becomes cultural, not individual. In the countries where you live, what economic behaviors still continue as cultural habits, even though society no longer realizes which trauma originally created them? Now let's look at Japan's asset bubble in the late 1980s. Banks gave loans against real estate collateral. As property values rose, the collateral became more valuable, which justified even more lending, which pushed prices even higher. At the peak of the bubble in 1989, the land beneath the Tokyo Imperial Palace was theoretically valued higher than the entire state of California. The Nikkei 225 reached its peak on December 29, 1989. What followed was not just a recession, not even simply a crisis. It was a 30-year deflationary grind, during which the Ponzi stage of debt accumulation was slowly unwound. Japan's lost decade became 2 decades, then 3. The Bank for International Settlements tracks changes in the ratio of private credit to GDP as one of the most reliable predictors of banking crises. Their research shows that when this ratio rises by 10 percentage points within 3 years, the probability of a banking crisis rises significantly across different economies and time periods. If these kinds of structural patterns interest you, then you need to pay close attention. Because the third sign explains why the other 2 remain invisible for so long. Third sign: the bond market tells the truth before everything else. There is a signal hidden inside the bond market, and we should explain what we mean by a hidden signal. The people trading in this market unknowingly reflect collective knowledge into prices while making buying and selling decisions. Nobody says, "Let's create a signal now." But the combined decisions of millions of professionals acting in their own interest create an extremely reliable picture of where the economy is heading. Over the last 50 years, it predicted every major recession in the United States in advance. It does not require complicated models. It does not require special data. Everyone can access it every day. Its name is the yield curve inversion. Under normal conditions, lending money for longer periods requires higher interest rates. A 10-year loan should cost more than a 2-year loan. Longer maturities mean more uncertainty, more risk, and more demanded compensation. This is logical and intuitive. When this relationship reverses, when 2-year Treasury yields rise above 10-year yields, something meaningful is being said. The bond market, home to the world's most informed and best capitalized investors, is expressing a collective judgment. The short-term economic environment will be worse than the long-term one. Rates will probably fall because growth will weaken. The distant future is less dangerous than the near future. The Federal Reserve Bank of New York operates a recession probability model based entirely on this signal. Its track record is documented and public. The curve inverted in December 1988. The recession came in July 1990. The curve inverted again around 2000. The dot-com recession started in March 2001. It inverted in August 2006. The global financial crisis began in December 2007. It inverted again in March 2022 and reached the deepest inversion in 40 years by 2023. Each time, the institutional response followed the same script. Economists published papers explaining that the inversion was a technical anomaly, how quantitative easing or foreign treasury demand had distorted the traditional signal, and why the old rules no longer applied. The signal did not care. Why does this work so reliably? Because the yield curve is not a prediction. It is a real-time summary of actual capital allocation decisions made by every institution managing global sovereign debt. These are not theories. These are bets made with real money by people whose careers depend on being correct. Let's examine this through a historical lens that goes back long before modern bond markets. Think about the repeated sovereign debt defaults of Philip II of Spain in the 16th century. 1557, 1560, 1575, and 1596. The Genoese banking families financing the Spanish crown reacted in exactly the same way modern bond markets react to yield curve signals today. They demanded higher compensation for short-term loans. They shortened their exposure periods. They demanded collateral. The gap between what Spain paid for immediate credit and long-term financing widened significantly after every new default event. The Genoese bankers were basically doing the same thing modern bond markets do today. They believed the short-term environment was more dangerous than the long-term one. Spain was under severe financial stress and faced a high risk of failing to repay its debt in the near future. They expressed this view not through surveys, but through pricing. The Spanish crown, believing in its own indispensability, in being the greatest empire in the world and the destination of all the silver from the Americas, dismissed these signals as the worries of cautious bankers who failed to understand Spain's unique position. Philip II told his finance ministers that God would not allow Spain, which was carrying out a sacred mission, to fail. Spain defaulted again in 1607. The Genoese banking network collapsed. The center of European financial power permanently moved to Amsterdam. The yield curve cannot lie, because it is not a prediction. It is the collective behavior of the world's most sophisticated capital allocators managing sovereign debt. When they see short-term risk as greater than long-term risk, they express that belief not with forecasts, but with real money. This is what 800 years of financial forensics truly reveal. These three signs, the illusion of "this time is different," the Minsky debt threshold, and the yield curve inversion, do not appear independently before a crisis. They appear together. They feed each other. They form a system. The illusion of "this time is different" allows debt to accumulate beyond the Minsky threshold. If people clearly recognize the pattern, they would stop. But the psychological mechanism of bubbles systematically suppresses pattern recognition in the very people who need it most. This debt accumulation then distorts the institutions responsible for giving warnings. Central banks, which should raise interest rates to cool credit expansion, instead adapt themselves to the system, because raising rates aggressively would immediately expose the fragility of the Ponzi structures already embedded inside the system. As debt reaches fragile levels, the yield curve starts reflecting it. Long-term bond buyers see what is coming. They shorten duration. They move toward shorter maturities. The curve inverts. And at that exact moment, the "this time is different" reflex reaches maximum intensity. Because an inverted yield curve uncomfortably suggests that the expansion is unsustainable, and that part of the prosperity of the last decade was borrowed from future pain. In its 2023 annual report, the Bank for International Settlements pointed out something that almost no mainstream outlet discussed. The combination of global debt levels and current interest rate conditions had created a systemic fragility profile comparable to, or even greater than, the period before 2008. They especially highlighted compressed spreads in corporate credit markets relative to underlying credit quality. They pointed to the divergence between asset valuations and underlying economic growth. They were measuring the convergence. All three signs were appearing at the same time. History does not announce itself. It does not send calendar invitations. But it does leave behind the same evidence across 8 centuries. The same 3 warning signs. The same institutional rejection of those signs. The same unavoidable reckoning. The information was never hidden. Reinhart and Rogoff published 800 years of data in a single volume. The Bank for International Settlements publishes its assessments every year. Yield curve data is available to anyone with an internet connection. The problem was never access to information. The real issue has always been the structural incentives created by careers, institutions, and political cycles that encourage people to look directly at the evidence and still choose not to see it. Understanding these signals does not give you an exact date. Financial history has never worked that way. What it gives you is something more valuable: clarity about whether the conditions for a crisis already exist. A storm never announces exactly where it will strike. But you can still know with reasonable certainty whether you are already standing in its path.